Hello and welcome to a brand new episode of Smart Money. Since it is the last day of the financial year, we decided to kickstart FY24 with some big themes that you can watch out for, some investment themes, some stock ideas as well, and how you should be approaching what could be quite a volatile year. Our expert today is Gurmeet Chadha of Complete Circle Consultants. Gurmeet, thanks so much for being with us. Now, there are 3 or 4 themes that you're going to talk about, so I'm not going to waste too much time. But just at the onset, tell us that is this a time to be deploying money right now, or do you think that one can get better levels in the days to come?
Sonia, I think we are not out of the woods yet, but I think the problems which were probably, are probably peaking. I think high interest rates, I think we are nearing the top, if not the top. Inflation also, I think the trends would probably be on the downward side, should surprise you over the next few months, also because of the base effect, right? February is when the war even started. And these shocks in global financial system are almost like 1.5% rate hikes because it squeezes credit. And it's also suddenly, it's disinflationary in nature. It just kills demand also to a certain extent. So I think we are getting there, but saying that it will be out is not a good time. Typically, when the headline is negative, when you haven't made money for, let's say, 18 months, usually history tells us that it's a better time. But you can stagger instead of trying to capture absolute levels.
Okay, so stagger your investments. Let's get straight down to the themes because this is what, the street is eagerly looking forward to. And the first theme that you speak about and you're bullish on is the QSR space, quick service restaurants, as well as this whole opening up theme, which is the hotel industry. Now, here there are a lot of stocks which have, in any case, gained quite a bit in the last 1 year. So tell us a little bit about where the alpha lies, Gurmeet, and what are the stocks that you're looking at here?
So, Sonia, if you see this industry, the total market cap is hardly about 65,000 crores. And if you see these QSR chains, they've been growing pretty well. So, they entered India in 90s, but if you see 2000 to 2010, they were adding like 100 stores. Last decade, they started adding about 250, 300 stores. And now we are getting to that 450, 500. So in this business, you have very negative working capital. A 20 EBITDA business in QSR is actually equal to a 30-35 multiple for a normal, let's say, consumer business, because of the nature of rotation. So I think we are reaching there in terms of reach. They are covering about just 26% and serving only 14%. So I think we are likely to see what the Western world has seen in QSR. I like a lot of names in this space. Also, this trend of nuclear families, working women. In fact, in a lot of countries in Asia, you don't have kitchens anymore, right? And so I think our overall cooking time is reducing. So it's pretty structural. But you have to be important, as you rightly said, you have to pick the right ones, especially which have more presence and which are growing. So something like a Westlife, which is, doing pretty well. And they have great supply dynamics. Actually, 100% Indian QSR, almost 95% procurement locally. We interact with some of their vendors, including Vista Processed Foods, which is their chicken guy. You have the distribution partner, which is RKFL. They have almost 60 suppliers and great, supply chain management. So it's very important, when you are in a centralized kitchen kind of a concept to ensure quality delivery last mile when you are expanding. So it's extremely important there. And I think this industry is likely to become, as I said, maybe $35-40 billion, which is 2.5 times in the next 3-4 years. And we probably are headed, as I said, to where China was, So look at, for example, Domino's is covering now 400 cities. The Yum brands, which is KFC, Pizza Hut, and Costa, that's more than 200 cities. And the response is pretty good even in tier 2, tier 3 towns. So I think within food services, I think this space will gain more and more traction. The stock names are more for illustration, of course, just as a disclaimer, and not just pure buy recommendations.
Got that. And of course, a lot of us have spent, over 2 years just eating ghar ka khana, right? So now there's that pent-up demand as well. People are now going all out and sort of binging, eating out, etc., getting back to normal life. Got that. The other space you like is the hotel industry. Now, this seems to be a no-brainer because there's so much that's, there's so many triggers here. There's the G20 summit. There is, wedding season in full throttle. There's also the whole there are so many long weekends coming up. So this is a space that looks good. But names like Indian Hotels, etc., have done their bit, right? Don't you think a lot of it is priced in?
Some of it, yes, in the near term, because one is Sonia, which is event driven, right? Which you talked about, G20 presidency, the World Cup, right? IPL. A lot of, which are near-term revenues. Second is more structural as a business model. So since you spoke of Indian hotels, for example, it has been a structural change. It's an asset-light model. So they have right now an inventory of 9,000 rooms, which I think Puneet spoke of in our last interaction, even in media, and most of them are on a fee model, right? So they're not really incurring, build up, designing and then generating revenues out of it. The second is the way the corporate travel is picked up, which is a revival of economy. If you see this year, for example, the foreign tourists in H1 would actually cross pre-COVID levels. Third is a sustainable shift in other revenues, right? So while the ARRs and occupancy rates are pretty good, it's the way they're trying to capture other revenues, which is food delivery and other banqueting services as well. So I think one is the model which is changing, and that's why probably you will see few more quarters, I think, and probably further re-rating in this space. Anything, obviously this business is also susceptible to any external shocks, right? So any war news or anything related which is geopolitical can have a bit of an impact. So one has to be careful here from that point of view. So it's a hybrid RM. So we track a lot of names in this space, which is Lemon Tree, Indian hotels. I was checking the ARRs for Indian hotels. It's crossed 15,000, and I think probably you'll see this trend for a few more quarters, which could mean that they will possibly generate 600-700 crores kind of an EBITDA quarter on quarter, which could further re-rate the company, quite a bit.
Okay, so let's move on to the second theme, right? The next theme that you're looking at is capital goods and the brick and mortar old economy stocks. Now, within this, the first stock that comes to your mind is L&T. And this year has been good, pretty good for a lot of these capital goods defense companies, at least the last 12 months. But tell us, what are the triggers here? And apart from L&T, which are the other stocks that you like?
So, I call this old economy because they have been languishing now, and it was all new age, startup ecosystem, platform businesses, specialty chemical, China person. So I think the old age economies are coming out because, typically what happens is when interest rates go up, and world is, likely to see a huge supply shock what it saw, you rebuild, right? You rebuild supply chains, they get reoriented. So, for example, and there's a huge government push, right, on both in infra. In fact, in India, for the first time, I've seen some, early green shoots of corporate capex. So if you see the top 200 corporates, Sonia, the capex is about almost $250 billion, which is almost like what, $40-50 billion a year. I think this will pick up, and this is housing led. This is, some of it is government push, which is infra led and affordable housing led. So L&T, for example, always order book has never been the problem. I think the execution is clearly improving, and you're seeing now look at the mix of the order book. It's not so EPC is not just the normal EPC and infra. It is green hydrogen. It is data centers. It is related to electrolyzers, related to the energy transition, right? And very good working capital management considering the stress we have had. Then you'll have tailwinds of softening commodity prices, supply chains easing, and I think they have a clear target of getting to about 18% ROEs. I also like something like Reliance, which is I think now on the process of encashing their digital ecosystem, which they have been building for a long period of time. We today saw the news of the demerger of their financial arm, which I think can unlock a lot of value. Huge run up in the stock today has been languishing. I think some of the energy assets will get monetized as we go along. I don't think so they're going to go the geo way of spending for 5 years and then monetizing. I think it will happen along the way. And there are other energy names, cement names, which I think, so cement again, for example, huge demand there and pricing power coming back. So I think those are the names which we are tracking. So it's as I said, it's a combination of cement, infra, capital goods, also defense and railway being subsets of it. Look at the way the orders are coming. Even some of the PSUs doing well. We track so many PSUs now, courtesy the defense and railway space. Been tracking HAL and Bharat Dynamics, etc. A lot of work happening there, and very reasonable valuations. More importantly, in an environment like this, you got to look at growth at reasonable price. A lot of the spaces where the price might have corrected, the valuation might still not. So don't confuse price correction with just valuation alone.
All right. So within cement, I mean, looking at the largest players, right? There's Ambuja Cement, there's Ultratech Cement. You spoke about a pickup in demand, but we're also seeing softening of a lot of raw material prices, which is the other big benefit for many of these cement companies. Got that. Moving on to the third space, which is financial, something that you like. And I don't know. I mean, correct me if I'm wrong, but this seems to be an evergreen theme, a little bit of an overcrowded trade. Anyone you ask what to buy in a dip, they would say ICICI Bank and HDFC Bank. So, I mean, I know it's good to be safe and conservative as well, because that's what you gain in the longer run. But don't you think this is a bit of an overcrowded idea now?
So yeah, I mean, I agree. I mean, I've been personally probably invested in top banks for more than 10 years now, and sometimes boring is good, and the environment we are in probably something which is what I'm more constructive on is that despite the best metrics we have, I don't think so. I've seen this kind of metrics in banks while I've been invested for a very long time. So you look at asset quality trends, including PSUs, for example. You look at the credit growth. When was the last time we saw 15-16% credit growth? And across the space, not that few banks, reporting it. Look at the way the liability side is. A lot of, we always focus on names and asset quality and NPA. Look at the way the banks are, transitioning from wholesale deposits to granular deposits. I think liability is the raw material for banks. And I think valuation wise also, if you see last 5 years, they'll probably be at the lower end. I have not seen HDFC at 3 times book, or ICICI, despite all the turnaround, is still what 2.2, 2.3 forward price to book. So valuations are reasonable. You have best metrics, which I think, and FI, it's a concentrated trade, crowded trade, because FI has also won 50% financials. So when they exit, which they have been doing, they do get impacted. There are a few niche names which we are tracking, so Poonawalla, I think, is one name which I think will probably do very well. I think the risk metrics they are following is pretty good. So I met their risk team recently. They have so just to give an example, they go for 700 CIBIL score. Usually banks are at 600, 650, which means they are avoiding new to credit, right? And the kind of segments they are in, I think they can grow that asset base by 35-40%, which in this environment is pretty good at like 10.5-11% margins. They are shrinking branches, right? Going digital, and yet targeting 35% kind of growth. And all sub-asset classes, whether it is PL, supply chain, working capital related, pre-owned cars, which is a new segment coming in. It's pretty good. A lot of digital initiatives happening. Good turnaround since the Poonawalla, the Magma Pincop acquisition in FY21. So that's one niche space I'm looking at, other than the boring banks which you mentioned.
No, boring is good. I take that. I take that entirely. All right, let's do one thing. Let's take a short break. We still have 2 more themes to go. Don't go anywhere. We'll come back with the big investment themes that you can look out for in FY24.